US President Donald Trump has whipped out his 2018 tariff playbook yet again on the table. He's brought in more tariffs and investor fear is skyrocketing, and because of that, stocks are hitting new lows. Markets are also bracing for slower economic growth and company earnings. The S&P 500 is now down 9.3% from its record all-time high, and we'll probably see another 10% fall in stocks and a bear market. So beware of alluring gains and bear market traps with stocks like Applovin, Tesla, strategy rising about 8% each overnight. Here's what you need to know today and consider. Welcome to the Daily. My name is Jessica Amir. I'm a market strategist here with Mumu. Thanks for tuning in this Wednesday, March the 12th, 2025. So what is happening? Well, Trump ordered 25% tariffs on steel and aluminium. If you want to call it aluminum, that's up to you. He's ordered that coming into effect tonight. At one stage, he actually threatened to double those tariffs, and this mayhem basically caused the market's fear gauge to hit a new high that we've seen. We haven't seen this level this year. So we saw the VIX, or volatility index, hit 29.6. It's now settled back down to a reading of about 26.9. But basically, this highlights the fragility of what is unfolding. Now, if we think about the S&P 500, just showing a chart here, the S&P 500 has now continued to fall. As we said at the outset, it's down 9.3% from its record all-time high. Now, yes, the market is near a correction, meaning it's close to being down 10% from its high, but I don't want that to be the focus. We should compare what's going on now to 2018. And if that scenario replays out, then you would be looking more close to a total pullback of 20%. So that's why I'm saying expect a pullback of 10% from here, meaning our market will be sitting with a bear market loss of 20% in total. What's adding into this equation is that now overnight we've got more renewed investment banks seriously downgrading global growth, but we've not really seen earnings be lowered. And once this happens, this will cause market shocks. Also, beware of bear market traps. Applovin, Tesla strategy surging. Their shares rose to the tune of about 8% overnight, depending on what you looked at. Applovin is a great example. These gains that investors are seeing, people might be buying in thinking that this is the bottom, but I suspect what's happening here is tactical buying for short-term moves. Secondly, there's also investors closing shorts. Now, this basically means investors are closing positions where they've betted for stocks to fall. Stocks have fallen. So they're taking their profits, and that essentially means they're buying the stock to close the short. It sounds complicated if you are not used to options, but all I'm simply saying is gains look alluring. If we know the reality that these are bear traps, meaning the gains that you can probably see over the short term, they're probably not going to be sustainable. So what I'm trying to say as well, another way to put it is these stocks will probably be heading to lower lows because tariffs on chips, remember, that'll probably impact stocks such as these, Applovin, strategy, Teslas. So consider taking profits when you see gains and don't be fooled thinking the bottom is in. What about the Aussie share market? Well, Australia's share market is expected to face a dark day. Earlier, the futures were suggesting a fall of about 1.1%. And that's pretty much because the Australian market needs to come to grips with $1 billion of Aussie steel and aluminium imports, or rather exports to the US being hit. So stocks that could be impacted by tariffs and weak sentiment indeed include BlueScope Steel, Sims Metals Management, BHP, Rio Tinto, Fortescue Metals. Sims is one that I would encourage you to look at. They make 25% of their revenue from the US, so obviously that'll take a big punch to its earnings. Keep an eye on Sims Metals Management. Moreover, taking a big step back, thinking about the broad Aussie share market, do consider that downward pressure is probably likely because companies need to adjust for less earnings, less profits. And as we said yesterday, the Aussie share market, the ASX 200, is now down about 8.4% from its record all-time high. But if we do see that 2018 trade war playbook repeat, our market will probably be sitting with a loss of 15% from peak to trough. So we've got a fair bit to go before we perhaps hit a bottom. But to get you through, do focus on stocks that are growing their earnings and I guess keeping a steady, even keel despite the mayhem in markets. So that might include gold companies, healthcare companies, staples. But what about Netflix and McDonald's? They've actually been doing pretty well. If you haven't been paying attention to McDonald's, here's a chart of McDonald's. They've indeed been growing their earnings and their revenue, and that's probably why their shares are up about 6% this year. They've definitely outperformed the market. But aside from the last couple of days of selling, McDonald's shares have been trading in brand new record all-time high territory. Keep in mind the company recently reported earnings back in February. Profit growth was at 69%. Earnings over the year up indeed, and earnings are expected to continue to grow to the tune of about 5.2%. The bottom line is there's always pockets of green and gold somewhere, and there's always a bull market. You just need to find it. It's great to have your company today for the daily. For all stocks mentioned, head over to Mumu's platform for plenty more information.